In our yesterday's class, we have done till types of financial market, wherein we have discussed about stock market, over-the-counter market, bond market, money market, derivative market, and foreign exchange market. Today, we'll continue with functions of primary market. Okay. Now, what are the different functions of primary market? To raise capital for companies and governments, issuance of securities, price discovery, liquidity to investors, underwriting, public offers, regulation and transparency, and capital formation. Okay, as we have already seen, primary market, also known as new issue market. This is the market wherein securities are created and it is sold for the first time. Okay. Now, how you are able to raise capital for companies and governments. Basically, companies and government they use the primary market to raise funds. Okay. How do they try to raise funds? By issuing new securities like stocks, like bonds to the general public. And whatever the capital that is generated with this, with the issuance of bond, with the issuance of stock, this capital is used for expansion of your business or for paying off your debts or for funding your public projects or for research and development. So, whatever the capital that is raised, okay, by issuing your stocks and bonds, those are those capital is used for expansion of your business or to go on for research and development or sometimes paying off your debts. Next, coming towards issuance of securities, as we have already seen, basically the primary market, okay, it tries to facilitate the issuance of new securities, that is including your stocks, your bonds, equity securities. Your bonds are nothing but that are your debt securities. Okay, so whatever the issuance of new securities are, like in case of equity securities, the company will try to share the sell the shares of the uh, to the general public. The company will try to sell shares to the general public in case of equity securities. While in case of debt security, the company they will try to issue bonds. They will try to promise to pay the borrowed amount whatever that was levied along by paying with the help of your interest. Okay, this is how you can go with issuance of securities. Third function is your price discovery. Okay, price discovery is something, the primary market, the money market, that helps you to determine the initial price of your securities. For example, in your IPO, that is in your initial public offering, the company will try to set an issue price for the shares. Okay, so whatever the price that is set, this pricing is often determined based on the company financial position, based on the company financial health, with respect to your market condition, with respect to the demand for the securities. Then only the price can be discovered or the price is determined by the underwriters of the company. Next is liquidity to investors. Okay, here this market will try to provide investors with the opportunity how to buy securities directly from the issuer, or they will try to give them a way to participate for the growth of the company or to the government entity. So this issuance of security, it allows the investors to come up with the potential how they are going to sell them in the secondary market just to get cash, just to get the liquidity of your company. Okay. Next, underwriting. Whenever you are trying to sell your securities, the investment banks or the financial institution, they have to underwrite the security issued in primary market. That means a proper written note should be there that so and so securities are being sold into the market, are being shared into the market to the investors who are interested in purchasing them. So here the underwriters, what they are trying to act as intermediaries between the issuer and between the investors, just to guarantee whether the sale of securities by purchasing them from the issuer or you are trying to resell them to the general public. Okay, next is your public offers. Okay, this public offers, I mean, in the primary market is where the companies they try to make their securities available to the general public just for the first time. Okay, that we refer to as initial public offer, right? Or it can go with the help of private placement, that is taking the help of your third party agencies. So basically IPO is the best example for it, where the company will try to offer its share to the public for the first time. Okay, next is regulation and transparency. The primary market, they have to go on with the regulations of the security commission. Okay, security exchange commission like SEC, or in SEBI, Security Exchange Bank of India, just to ensure fairness, to ensure transparency, to protect the investor interest. Okay, so there should be proper transparency, or there should be certain rules and regulations in order to go for the exchange of your security from one party to the other party. So here the issuers are required to file a detailed financial statement, or there might be some other documents that they make sure to invest whether they have all the necessary information in their hand to make a proper purchase before they make a purchase. So proper documentation should be there in their hand whenever they are going for IPO. Next is capital formation. Okay, unless and until you are just able to enable the issuance of new security, the primary market basically it helps in capital formation. Okay, when it is trying to help in capital formation, it tries to contribute to your economic growth. Okay, so whatever the capital that is raised, this capital can be used for your productive investment. This leads to your job creation. This leads to overall development of the economy. So, in general, whatever the securities that are being sold in the primary market, that plays a critical role, that plays a crucial role in how you are able to facilitate the capital formation that allows your company or the governments to raise funds. And also, it tries to offer your investor opportunities to purchase your new securities. Okay, so here we are just trying to provide a kind of a transparency, a kind of a price discovery and regulation to ensure a fair process is being carried or not. Okay, now next is coming towards book building method of public issue. Okay, book building. Now, what do you mean by book building? Book building is a price discovery process in which institutional investors and sometimes retail investors they submit bids for shares within a specified price band. Okay, so here what is being happen in book building? Here in book building, we are just trying to allocate securities for an IPO or other public issue. So when we are trying to keep an IPO, it helps the issuer or the company to determine the most appropriate price for your security. That ultimately depends on your market demand. So this method, the bookkeeping method, is widely used to price your IPOs and is often preferred due to its inability to reflect the true market demand for the shares. Okay, are you getting? So the main goal of book building is something to find an optimal issue price wherein you are trying to reflect your market willingness to pay for that share or not, just to make ensure that the offering is priced competitively and in a very fair manner. For that purpose, you are just going for book building method. And when you are going with this particular method, you have got certain participants in the sense the people who plays an important role in book building process. Okay, who are those? The first is your issuer. Second is your lead manager. Third is your investors. And the fourth is your stock exchange. Okay. Now, who is the issuer here? Issuer is nothing but the company. The company is trying to look for the people to raise funds through issue of new shares. Okay. Who is the lead manager? Lead manager is also called underwriter. Okay, underwriters are nothing, or the lead managers are nothing, but these are the banking institutions or the investment bank or your financial institution who tries to manage your book building process. So these are the people who are basically responsible for structuring the issue, for pricing the security, and also marketing the issue to investors. That means going on with marketing campaigns, how you are bringing your security into the market. So your banking institution, your financial institution, or your investment banks, these are the people who are responsible for this. Next is your investors. Investors are nothing but ultimately your institutional investors. Who are your institutional investors? It can be your insurance companies, it can be your mutual funds, it can be your pension funds, or your retail investors who bid for your security. Those are your investors. Stock exchange. Stock exchange is nothing but this is a platform where we are trying to eventually list your new shares for trading purpose after the offering is made. Okay, so these are the four key participants who plays an important role in your book building process. That is your issuer. Issuer is a company. Lead manager or underwriter. These are your banking institutions or your financial institutions who are basically responsible for structuring the issue or going up with the pricing of your securities, and also how to go on with the marketing campaigns in order to issue it to investors. And investors are the your it could be your mutual fund investors, it could be your retail investors, it could be your institutional investors, or what do you say, your your pension funds. Okay, these are your investors. Stock exchange is nothing but the platform that you're using in order to list your shares, list your securities for trade off. Okay, now next coming towards your steps in book building process. So basically you have got nearly 8 steps for it. That is, first is selection of lead managers, setting the price band, roadshows and marketing, bidding by investors, collection of bids and demand assessment, price determination, allocation of shows, and listing of shares. Coming towards the first step, that is selection of lead manager. Now, who is your lead manager? Who will select your lead manager? Basically, in an organization, the company will try to appoint one or more lead managers. That lead managers are nothing but your underwriters. Okay, what do they try to do? They try to handle the entire process, starting from setting the price range, marketing your security, and then managing your subscription process. So it is a responsibility of the company to appoint either one manager or more than one manager to handle the entire process which are required for your security in order to sell your security. Next is setting the price band. Okay, who will set the price band? Basically the issuer and the lead manager. Okay, they will come on an agreement of a price band, that is a range of price for your securities. So this price band is only disclosed or disclosed to a particular potential investor, okay, who are trying to come up with their offer. Okay, for example, the price band typically includes a lower and upper limit. Okay, when an auction is going on, we just put a price range for it, 100 to 200 or 100 to 120 per share. So the final price, who is going up with the highest bidder, okay, they will be getting that proper security. That is, the final price will be determined based on the investor's demand of that security. Next is roadshows and marketing. Okay, here the issuer or the lead manager, they will try to organize roadshows, or else they will try to conduct meetings with institutional investors, or to third party agents or to brokers to just generate interest in the issue. Okay, so in this particular meeting or in this particular show, we are just trying to present the company financial growth, that is growth potential and investment case. So here all the investors who are interested in buying the security, they are invited to submit their bids within a specified price band. So whichever investor is going up with the highest bidding process, that particular investor will be winning the security of the company. Next is bidding by investors. Okay, now what do you mean by bidding by investors? Here, investors are nothing but who are the investors? Your institutional banking institutions or your retail investors. They will try to submit their bids within the price band. Okay, this bid indicate the number of shares they want to buy and at what price they want to purchase it. That means at what price they are willing to purchase the shares. So basically, this institutional investors may be given priority in allocation over your retail investors. But here, exact allocation has to be based on the demand of your regulatory guidelines, whatever the guidelines that are set. Based on those particular guidelines, exact allocation of how many shares they are going to purchase, that has to be set. So this process basically it lasts on for 3 to 7 days, during where the investors they try to place their bids through brokers or sometimes through online platforms. Okay, now next is collection of bids and demand assessment. After the bidding period ends, here what is the bidding period, what is the bidding period here? 3 to 7 days. So after this particular period ends, the underwriters, okay, or your lead manager, what do they try to do? They will try to assess the demand for the shares at various price levels. So whatever the investors or your banking institutions they are giving up their prices, they just try to assess the demand of those shares at various price levels, and they will compile a book of bids that shows how many number of shares that are requested at different price points. Okay, what investors are, I mean how many shares they are purchasing and at what level of price they are just purchasing it. So this helps them to assess the overall demand for the shares at each and every price level. Okay, so wherever the price level of the number of shares are going high, so to that particular investors your shares are being given. Next is your price determination. The final price is ultimately determined based on the bids that are received from your investors. So here the issuer or your lead manager, they will try to analyze the demand for the shares at different price points. Okay, the price is usually set at the highest one, where the total demands meets the supply of your shares that is offered by the issue. So if the demand is very high, the price might be set at that particular point of time, at that particular top of your price band. So this process is basically designed to just reflect the market willingness to pay for the shares or not. Okay, there we are going to determine your price. Next is allocation of shares. Okay, once the price is determined, okay, what are we trying to do? We are just trying to allocate the share to successful bidders. How? By making an allocation. The allocation is done based on the amount of demand at each price level. So institutional investors they receive a large portion of their allocation, while retail investors they get smaller portion. And sometimes this can vary also. There is not a fixed portion for it. Like investors will be getting higher portion and retail investors will be getting a less portion. Here or there, it goes on changing. But at the max, the institutional investors will be getting a maximum portion of your securities. So here the issue can be oversubscribed. That means where the demand is exceeding the supply. Okay, in which case the shares are allocated to a particular person or to a particular investor through a lottery system. To that particular person, we are just trying to sell our security. Next is listing of shares. Okay, after the allocation is made, the shares are listed on the stock exchange and it can be traded in the secondary market. So the company here, they will try to receive the fund from the issue uh, and from the investors where they were trying to sell or hold their shares based on the market condition. This is how you will try to list your shares on your online platform or on your offline platform. Okay. Now next you have is steps in public issue. Okay, that means what are the steps in your public issue? So before we start this steps in public issue, the book building method. This is something. What do you say? A modern method, you can say, where we are just driving the market to price and allocate shares in public offering, where it allows a company to raise their capital at a very fair price by allowing the investors with the opportunity to bid for the shares in which they are willing to pay. Okay, no doubt it's a very complex process, but here fixed price offerings are made. Okay, now coming towards next is steps in public issue. What are the steps that are required in your public issue? First is appointment of intermediaries. Second is preparation of a document, filing with regulatory authorities, marketing the issue, determination of issue price, opening of the issue, closing of the issue, allotment of shares, listing on stock exchange, and post issue monitoring. These are the steps that are required in your public issue. Basically, the public issue, this is a process where we are offering our securities, your stocks, your bonds to the public to raise capital. So it involves various steps from preparing the company to go to public to the listing of your securities on stock exchange. So for this we have certain steps. Okay, coming towards the first step, that is appointment of intermediaries. Okay, when we are appointing intermediaries, who are the intermediaries over here? It's nothing but your issuer, that is the company. Next is your underwriter or your lead manager, you can say. Next is your advisor, that is legal advisor you have. Next, your auditor, your registrar. Who is the issuer here? The company who is trying to raise capital through the public issue. That means the company planning to raise capital through the public issue. That is he is the issuer, or that particular entity is the company. Lead manager, these are typically your investment banks or your financial institution who are responsible to manage the issue. What do? They will try to guide your company through the entire process of your book bidding. Okay, and they will also assist in your pricing, and also they try to help in distributing your securities to the people who are interested in buying it. Who are the legal advisors here? Lawyers. Ultimately the lawyers help the company in drafting legal documents, and also they will try to ensure, I mean, whether it is going as per the rules and regulations or not. Auditors are nothing but these are the people who are responsible to audit your company financial statements, and that should be certified by your external auditor. Okay, registrar also is there in this intermediary. Registrar is the person who is responsible to process your application, who is responsible to allot your shares, and also to maintain records to whichever the investor institution you are just selling your securities. Okay, so these are the intermediaries who are appointed. Okay, that is the issuer, your lead manager, your legal advisor, your auditor, and your registrar. Next is preparation to offer document. Okay, in order to prepare a proper document, you should have a proper prospectus. Okay, what do you mean by prospectus? Prospectus is nothing but this is a kind of a document that the company prepares. Okay, this document, it includes the detailed information about the company, like how you have seen a pamphleter of a company. What does a particular pamphleter describes you? It describes the detailed information about a particular entity, about a particular company, its financial performance, I mean the risk factors. Okay, and also other relevant information you can say. Okay, so this is the preliminary version, and the final prospectus is issued once the pricing is determined by your underwriter or by your lead manager. So this document, it also includes information how many number of shares are being issued by the company and at what price, along with terms and condition, like how we have seen in your book building process. Okay, after a document is prepared, then you will file with regulatory authorities. Okay, who are your regulatory authorities over here? It's your SEC, that is Security Exchange Commission, then your SEBI, Security Exchange Bank of India. These are some regulatory authorities. So here the regulator, they will try to review the document that you have prepared, and also they will try to ensure whether it complies with legal requirements or not. Okay, although it will not verify the accuracy of the information, but whether it is going as per the procedure, as per the protocol of your company or not, that they will try to comply it with. If everything is in order, then the SEBI approves the prospectus and the company can proceed with the issue. Okay, next is marketing the issue. Okay, this goes on with your, marketing campaigns like your roadshow. Okay, so here the company, along with its what do you say, underwriters, or along with lead managers, they try to conduct a roadshow. Why do they conduct a roadshow? Just to promote the public issue to potential investors. Okay, so this includes making presentation to your institutional investors, or to your mutual funds, or your banking institution, or to your retail investors. Okay, so the roadshows, they were basically, it tries to help the company, or it will try to generate interest in the issue and provide investors with more detailed information about the company. When you're campaigning about a particular security, it shows like how you are able to describe your product in a more detailed, in a more elaborated way. Okay, after you go on with the marketing the issue, after you go on with marketing campaigns, next is determination of issue price. Okay, that means here you are going to fix the price band, price discovery, and fixed price offering. Okay, price band is something like how we have seen in our this thing book building method. The company and the lead managers, they will try to set a price band, that is a minimum and the maximum price at which each and every share will be offered to investors. Price discovery is something, here the issue price is determined through the bidding process. So based on the demand for the share at different price point, the final price is set. Fixed price offering is something, in this the price is determined beforehand and it remains the same for all investors. Okay, there is no such fluctuation that we have seen in your price band and in your price discovery. So in your fixed price offering, your price is fixed and this price is determined beforehand itself. It is uh, uh, irrelevant, sorry, it is not dependent on the shares of your investors. Okay, so once you determine your price issue, then you will be opening the issue. How you will be opening the issue? Either through your application process, or you can go with bidding process. If you are going with application process, what you will be doing here, the investors will be applying for the issues either through physical application or through online platforms. Okay, so when they are going with this application, physical application process, or through online platforms, they need to provide details like how many number of shares they would like to purchase. Okay, what price they want to set for, and their payment information. If you are going for bidding process, bidding process is something, this is the public issue that is open for subscription, where investors, they can submit their bids for the shares. So in case of a book building, what we have seen, institutional investors and retail investors, they have to submit bids within a price band. Okay, so the same thing is being followed here in your opening of the issue. So in opening of the issue, two categories are there. Either you can go with your physical application process, or to your online platforms, or you can go with your bidding process. Once the opening of the issue is there, then you have closing of the issue. Okay, how the closing takes place? Basically, the public issue, it remains open for 3 to 7 days. Okay, depending on the regulations. So during this time, the investors, they have to submit their application. Okay, and if the demand for the share exceeds the supply, that means if the issue is oversubscribed, here what will happen, the company may either allocate shares to the other means, with the other means like a lottery system. Okay, so that goes on with your subscription process. Next, you have your allotment of shares, share allotment. Okay, after the issue closes, okay, after the closing of the issue takes place, the company, along with its lead managers, they will try to decide how many shares will be allotted to each investor. If the issue is oversubscribed, shares are allocated proportionally to the investors based on their bids. Whoever is going up with the highest price bid, then that particular investor will be getting the share. If the investor is not allotted any share, then the money is refunded back. Typically, it takes some time. Okay, within a few weeks, the amount will be refunded to that particular investor. Okay, so once allotment of shares takes place, then you have to list on your stock exchange. So here, after the shares are allotted, the company applies for listing of one or more stock exchange, like how you have got your New York Stock Exchange, your Bombay Stock Exchange. Okay, once your shares are listed, the shares can be traded on the stock exchange. Okay, the market price is ultimately determined by the supply and demand and how the investors they are interested in buying or selling their shares. Once it is listed on your stock exchange platform, then you have to monitor the post issue. Okay, that means if there is high volatility in the stock price after listing, the underwriters they can take steps to stabilize the price, and they have to make sure the shares do not fall too sharply, neither too high nor too low. Okay, so the company must continuously provide regular updates to the market, either quarterly or going up half yearly or going up with annual reports and other significant changes. So, continuous monitoring has to be done for the post issue of your securities. Okay, apart from this, you can go for your right and preference shares, or you can go for allocation to institutional investors instead of going for bidding or your physical application process. So whatever the steps that are required in your public issue, it involves a this is something a complex procedure wherein every company they have to make sure whether they raise their capital in a fair and efficient manner or not by complying with the rules and regulations of your governmental agency. So this process is designated to just come out with a fair and transparent market for the new securities, which we are offering to your investors the opportunity to purchase their shares at a price that reflects the market demand. Okay, so for that purpose, we are just going up with this process of your process of the steps that are required in your public issue. Now, next is methods of floating point issue. Second. Now here you have got some methods of floating new issues. Public offer, that is IPO, right issue, private placement, offer for sale, Dutch auction, book building method, green shoe option, which we call it as over allotment or oversubscribed. Next is fixed price offering, small medium enterprise listing. Already we have discussed about IPO, we have discussed about your book building, we have discussed about oversubscription and fixed price. So the remaining part we'll just try to look into. So this floating issue in primary market, this is one of the important aspect of the primary and secondary market because it holds the stability of your financial market. Okay. Now, what do you mean by this floating? Flotation, floating new issues or flotation of new issues. This is the method where we are trying to make our shares available to public investors. So it is when a company decides to go on for public for its shares. So much so that the public investors they can invest in the same. Okay. The shares are open for issuing and selling. Ultimately, the flotation of a company, it gives a proper grip in the primary and secondary market. The more you try to raise funds, the more you try to raise money for your company, it ultimately aid towards more development of your company. And also here, the expansion of your business takes place, which makes room for your research and development. When you're expanding something, simply you just don't expand it. Based on some research only, based on some R&D purpose or based on some advice from your legal entity only, you just try to go on for expansion of your business. So here are some issues when you are just floating your primary market to the next. So the first is your initial public offering. Already we have seen this is the kind of an offer where we are trying to share where we are trying to sell our shares to the public for the first time. So here the company will prepare a detailed prospectus of their financial statements and whatever the information that is required. Okay, and the shares are offered to the general public through your stock exchange. Okay, so the IPOs are typically used by the companies just to raise capital for expansion, or sometimes in paying off your debts, that is debt reduction you can say, or it goes on for R&D purpose. Next is right issue. What do you mean by right issue? Right issue is nothing but we are trying to involve new share to existing shareholders in proper proportion. What do they hold currently? Okay, because existing shareholders, they are given the right to purchase some additional shares at a discounted price before they are put to the public for offering. Okay, so this particular method, it will try to help the company to raise its additional capital without getting the ownership, or without diluting the ownership of the existing shareholders. So the right issues are often used by the companies just to raise funds for the growth or to meet your working capital requirements. Next, you have private placement. What do you mean by private placement? In this private placement, we are just trying to sell your securities, or your securities are being offered to a certain group of your institutional investors, or accredited investors, rather than to the public. Okay, before we just share it to the general public, we just try to share it with your institutional investors or to your retail investors. That is referred to as private placement. So here the company will try to negotiate with some investors, such as your private equity firms or your venture capitalists will be there. So they will try to sell their securities directly to them. Okay, so when we are trying to sell our securities directly to them, it does not require to be listed on a stock exchange. Like how when we are putting our securities for selling purpose. Okay, what do we try to do? We'll try to put our securities on a stock exchange platform. Okay, so in private placement, this is not being done over here. Before we just present it to general public, we are just sharing it with your retail investors or with your institutional investors. So with private placements, these are typically used by companies who want to raise their capital in a very quick manner, or who do not want the cost and regulatory burden of a public offering. For that purpose, they go for private placement. Next, you have offer for sale, which we call it as OFS method. Okay, in this method, here, whoever the existing shareholders are there. Existing shareholders means your institutional investors or your promoters. Okay, to those people, we are just trying to offer their shares to the public. So instead of issuing new shares, we are just trying to sell it to the public through your stock exchange, the oldest method that we have seen. Okay, so in this case, the company may not raise any capital in this process. Rather, the existing shareholders, they will try to raise funds by selling their holdings. Okay, whatever the securities that are sold by the company, okay, the institutional investors will take it, will buy it, and again they will try to keep those securities for sale. So it's like a acting as a, I mean, these institutional investors or your retail investors, it's acting as a third party agent between the one who is going up for buying of security and on behalf of company. Okay, so this method is often used in case of privatization, where a government or some major shareholder, they offer shares to the general public. Next, you have Dutch auction. Okay, Dutch auction means what? This is a method, you can say, wherein the price of the security is determined through bidding process. Okay, for that we call it as Dutch auction. Okay, so in this process, the investors, they will place bids indicating the number of shares they want to purchase and the price they are willing to pay for those shares. So the issuer here sets a price that will clear all the shares at highest price, where the total number of shares can be sold. So in this method, this helps to determine the most appropriate price for your security based on market demand. That we call it as Dutch auction. Next is book building. Just now we have seen. So once again, we don't have to discuss. Over allotment is nothing but over subscription, which we call it as green shoe option also, where it allows the underwriter to issue some additional shares if there is a high demand for the new issue. Okay, so if the demand for the new share it exceeds expectation, then underwriter it has the option to sell additional 15% of its shares to stabilize the price and meet the market demand. So basically, this method is used to manage your market volatility or to stabilize the price of newly issued security. Next, you have it as your fixed price offering. Okay, in this fixed price offering, the price of the security is set in advance. Already we have discussed, and then offered to the general public at a fixed price. And the last is small and medium enterprise listing. Okay, this method is basically used for small and medium price enterprise where we are trying to raise capital by offering our shares to the public. So SME, these SMEs they can issue their shares either through an IPO, or they can go with the book building method, or they can go with the private placement method. So usually a separate exchange for smaller companies who are coming up with small type of business. Okay, so in this here it allows the SME to access their capital from the public market along by complying with the rules and regulations, but with less regulations when compared to the companies who are at large pace. Okay, so basically whatever the method that we are choosing for floating new issue, it ultimately depends on the size of the company. Okay, the capital needs of the company and the market conditions of the company, because each method it has got its own advantages, it has its disadvantages, or the companies they will try to select the method based on their goals, their investing purchase, you can say, they wish to target, and the cost that is involved in such method. So wherever they are getting the best price, and with whichever method they are getting the high number of shares with the best price, that particular method they will try to adopt it. Okay, now next coming towards money market. Just now we have seen about capital market. Now what do you mean by money market? Money market is a segment of the financial market, okay, where short term borrowing and lending of funds occur, typically for a period of up to 1 year. So money market is a short term market. Short term means 1 year and less than that. Okay, it should not exit more than that particular year. So this is a very crucial part of your financial system, where we are providing liquidity to your banking system, and also it enables your financial institutions or your corporations to meet their short term financial obligations. Okay, so this money market it will try to facilitate the trading of acquiring high liquidity, or you can say short term instruments that are at low risk, that makes it an essential component of your global financial infrastructure. For that purpose, we are just going up with money market since it's a short term market. Next is key features of money market. As we have already discussed, money market is a short term instrument, it's a low risk instrument, it gives high liquidity, interest rate, and regulatory oversight. Short term instrument. Okay. The money market basically deals with financial instruments that have got very, what do you say, short maturity period, that is less than 1 year only. So these instruments have got high liquidity ratio, meaning they can be easily brought, they can be easily bought, or they can be sold with minimal price fluctuations. Okay, and also next feature is low risk instrument. Since instruments are traded in the money market, they are typically at low risk only, because they are usually issued by governments or high rated financial institution with stable credit worthiness. Okay, For that thing, we have, this is a low risk instrument. High liquidity. Okay, high liquidity means the instruments can be quickly converted into cash with minimal loss of value. Interest rate. Here, the money market, they will try to set its benchmark. Okay, a proper goal is set for short term interest rate in the economy. So the rates in the money market directly it affects your lending as well as borrowing purchasing, as well as borrowing capacity or borrowing rate across the economy, that influence your overall economic activity. Okay, next is your regulatory oversight. Okay, the money market basically it has to regulate as per the governmental agencies or central banks such as your RBI, your US Federal Reserve, or your Central Bank of Europe. Okay, just to maintain financial stability and control inflation or your interest rate. Okay, next is types of money market instruments. These are some types of money market instruments which we call it as T-bills, that is treasury bills, repurchase agreements, that is repos. We call it as in short repurchase agreements, commercial papers, CPs, certificate of deposit, CD, call money, bankers acceptance. Okay, these are some types of money market instrument. Coming towards the first, that is T-bills. T-bills are short-term securities. Okay, this is basically issued by the government just to raise funds for short-term needs. Okay, so these are considered as one of the safest money market instrument because they are backed by the government. They are issued by the government. Okay, and the maturity for this T-bills, it range from 91 days to 364 days. That is less than 1 year only, right? So here the investors they will try to purchase these T-bills at a very discounted rate and are paid at full face value at maturity. When it gets matured, they will be paying the full face value. Okay, then uh, uh, these are sold at discounted price, and when it reaches the maturity value, you'll be getting a liquidity option for your short term investment. Coming towards your repos, that is repurchase agreement, this is again a short term borrowing arrangement, you can say, in which one party they will try to sell their security to the other party with an agreement to repurchase them at a later date. Okay, it's a kind of mortgage, you can say, like usually within a day or two at a slightly higher price. Okay, so this allows the seller to raise short term funds and the buyer to earn a small return. Okay, this repos are short term borrowing, you can say, which is typically set only for a next day or for few days. Okay, these are completely opposite. Okay, where the buyer of your security it tries to or agrees to sell them back to the seller at a later date for a fixed price, and the transactions are used to manage liquidity in the market with the help of your repos. Coming towards the next, that is commercial papers. Commercial papers are unsecured instrument. Okay, these are your short-term debt instrument which are issued by corporation just to meet their immediate financial need, such as your inventory management or going up with your payroll system. Okay, so the basically the maturity period is also less than 270 days only because these are sold at a discount to face value. Okay, and these are issued by your corporation or your financial institution or bank to raise their funds for working capital. Okay, next is your certificate deposit. Certificate deposits are timely deposits that are issued by your commercial banks which they pay interest to the depositor. Okay, the maturity again it ranges from few weeks to a year only. Okay, no doubt they are negotiable. That means they can be sold or transferred before maturity. Okay, and these are offered by your commercial banks or your financial institutions, and these are negotiable instruments. Call money. Call money is again short-term loan, where banks or your financial institution they borrow from each other only for overnight period. Okay, so here the interest rate is high sensitive to short-term market, which therefore we call it as call money rate. Okay, that means this call money rate it helps the bank to meet their immediate liquidity requirement just to ensure smooth functioning of the banking system. For that, we go on with this call money option. Next is your banker's acceptance. Again, this is a short-term debt instrument that is issued by the company to guarantee a commercial bank. Okay, here the bankers' acceptance are used to finance your trade transaction. They are used to often used in your international trade as well. Okay, if there is a proper acceptance from your bank in order to make a transaction, then it can be done with the help of your bankers' acceptance in your international trade. Okay. Now next you have functions of money market. Previously we have seen functions of capital market. Now functions of money market. What are the functions of money market? It's your liquidity management. Then you have your short-term borrowing and lending, price discovery, monetary policy transmission, stabilizing financial market, investment of surplus fund, facilitating efficient capital allocation, lowering the cost of borrowing, government financing. These are some of the functions of your money market. That means the money market it plays a crucial role in your financial system where we are trying to facilitate your short-term borrowing, your lendings that provides liquidity in assisting your efficient management of funds. Coming towards the first, that is liquidity management. Okay, liquidity management is one of the primary function of your money market where we are trying to provide liquidity to your business, okay, to your financial institution and the government. Okay, when we are trying to provide it, ultimately it helps the organization to manage their short-term funding by allowing them to borrow or lend funds for shorter period ranging from overnight to 1 year. Okay, when we are doing this, it will ensure our business and your financial institution to meet their daily operational requirement, like your how to manage your cash flow gaps, how to manage your payroll, how to manage your inventory system. For that purpose, we are going with your liquidity management. Next is short-term borrowing. Already we have discussed this. This is a short-term borrowing wherein lending of funds from your government, your financial institution will take place, and also it enables the borrowers to raise their capital for your temporary needs, that is short-term liquidity, or to bridge the gap, okay, of your short-term funds where a lender can return a money on their excess fund for short period. Next is price discovery. Again, this is an essential, I mean, this plays a very essential role how you are able to determine the short-term interest rate in your economy. The rates in the money market, these are used as a benchmarking to set your interest rate in the economy that include your loan rates as well as your deposit rates. So a proper benchmark is set in order to discover the price of your interest. Next is your monetary policy transmission. Okay, in your monetary policy transmission, central banks, okay, they use the money market to implement and control monetary policy. Okay, how do they control this monetary policy? By adjusting your short-term interest, or they will try to use open market operation like buying and selling government securities. Okay, wherein they try to influence the supply of money in the economy. Ultimately, this helps to control your inflation rate. This helps you stabilize the currency of your economy, and also it tries to promote overall economic stability. Next is how to stabilize the financial system. The money market basically tries to stabilize your financial system by ensuring whether you have a what do you say buying behavior or the avenue for your financial institution to meet their short-term liquidity requirements. So when you are facilitating the quick movements of your fund between your participants of your market, the money market it tries to reduce the chances of liquidity crisis. Okay, and when you are trying to reduce the liquidity of your crisis, it automatically enhances the stability of the banking system. Okay, next is investment of surplus funds. Okay, here the money market, it allows your investors such as your mutual funds or your pension funds or your insurance companies to invest their surplus funds in low risk, or for short term instruments like your commercial papers, your T-bills. Okay, so ultimately this gives your institution a place to park your funds temporarily, where your earnings, your returns all will maintain high liquidity but at minimal risk. Next, facilitating efficient capital allocation. How you will be able to do this? By offering an mechanism how to borrow or how to lend your funds, because the money market, it ensures the capital is allocated where it is most needed, and the funds whatever that you are taking, it should not be idle. It should ensure that business can access the funds wherever they require for short term operation purpose. Okay, whether it could be for your inventory, for your payroll, or for your working capital needs. Next is how to lower the cost of borrowing. Since in money market, basically your money market deals with short term funds, so ultimately the cost of borrowing will be lower when compared to long term goals. So here in your money market, the borrowers can obtain funds quickly at a very relatively low interest, you can say, which help the business as well as the government to come up with effective short term financing. And the last is your government financing. Okay, in your government financing, your government will regularly they use the money market to finance their short-term expenditure. Okay, how do they do it? By issuing short-term instruments such as your T-bills, which are highly liquid but at low risk. Okay, so ultimately, this will help the government to manage their deficit or short-term fiscal needs without relying on long-term debts. Short-term debts are too good when compared to your long-term. Okay, so basically the money market is essential for your financial system, where we are performing some key functions just to ensure your liquidity position of your company, the stability of your company, the efficient capital allocation, how you are able to allocate your capital at various levels. So by facilitating the short-term borrowing and the lending, it provides a platform for your price discovery. It tries to help your central bank to implement monetary policy that is going up with the uh, rules and regulations as per the government, just to offer a safe investment. Okay, so therefore this money market, it plays a very crucial role to maintain your financial stability and also how to support the economy of your country. Okay, next you have differences between capital market and your money market, that I'll try to discuss in my next class. Okay, we are facing shortage of time now. So in my next class, I'll just try to discuss the remaining part of it. Is it clear to you all? Is the concept clear to you all?
Yes, ma'am.
Okay. Then I'll just stop my class over here. In our next class, we'll try to continue with difference between capital market and money market.
Thank you, ma'am.
Okay. Okay. Thank you all for attending my session. Thank you.